Inflation is back, but it's not a level playing field. This is good for stocks, but it's truly a stock picker's market. We're going to show you the new trend that's developed and what exactly we can do about it. Consumer Price Index was released this week on a year-over-year basis, up 2.7%. This is the hottest rate of inflation going back to February of this year. Also, core CPI, excluding food and fuel, that's up 2.9%. This is also the hottest number we've seen since February of this year. So inflation certainly is back, but not for the producer. Here's a producer price index up 2.4%, a big drop from last month's 2.8% reading. Here's core PPI, excluding food and fuel, that's up only 2.5%. Again, the producer price index is the cost of raw materials that the producer pays. So prices are up for the consumer, but not the producer. Inflation is very much industry specific as well. Here's a consumer price index on a year-over-year basis designated by industry. The hottest industries, let's see if you can see the trend, coffee, meats and poultry, rent, primary residence, housing, food away from home. These are all up a lot. Here are the weakest levels of inflation, actually in the negative territory. Gasoline, airline fares, lodging away from home, food and fuel and other fuels, energy overall. Now, in terms of inflation, there are hot sectors. To be specific, coffee up 13.37% on a year-over-year basis. Electricity up 5.82%. Meat and poultry, fish and eggs up 5.76%. Notice also owner's equivalent rent of residences, primary residences, overall housing. That's up a lot. Shelter up 3.8%. Here are the coolest levels of inflation. At the bottom, gasoline down 8%, airline fares down 3%, lodging away from home down 2.4%. Putting them together, notice the divergence. On the left-hand side, used cars and trucks. These are things we need, and that is really the overall theme. Up 2.79%. New vehicles, inflation's up only 0.25%. So the things we need on the left-hand side are rising a lot. The things that we like but we don't necessarily need, that's cool. Here's another example. Take a look at food. That's up 3%. Apparel, down 0.5%. We need the food, don't necessarily need the apparel. Here's another example. Rent of primary residence, up 3.8%. Lodging away from home, taking a vacation, that's down 2.4%. So again, the things we need are getting more expensive. The things we'd like to have, if we could, well, those are cooling. We just can't afford those luxury items, the discretionary spending. In terms of the Federal Reserve, there's no reason to cut rates, not with inflation back. In yellow, S&P 500, the blue bars represent the probability the Fed will not cut interest rates in September. Notice the correlation. We've spoken about this a lot. As the probability the Fed will not cut rates in September, especially now with the hot inflation numbers, the stock market tends to go up. There's a positive correlation. So this is good news for stocks, but not all stocks. Every line here represents a different industry within the S&P 500. These are the 3-month gains that we've seen. Very stock specific. You may wonder, what are the best performing stocks? Well, take a look at the S&P 500. This is a 90-day performance again. For example, ETFs like XME and XSD up 50 and 65% respectively. But on the other side, XHS up only 2%, as well as XLV. There's a big divergence. Well, what are those industries? These are the strongest ones. Aerospace and defense, AI and cloud computing, hardware, software, semiconductors, also metals and minerals, gold and silver, things of that nature, semiconductors and software, semiconductor devices. Notice a trend, software and IT services. These are the weakest sectors. I'm sure you've seen these stocks. Healthcare equipment, home building, healthcare services, consumer staples, more healthcare, pharmaceuticals, real estate. The trend is pretty clear. So here are the takeaways. What's happening? Inflation is back, but not in all sectors. Consumer inflation, very much higher than producer inflation. Well, what does that translate into? It's great news for corporate profits. Imagine the position a lot of the corporations are in, especially in the technology sector. Their prices are not going up, but our prices we pay for the products are. That's better profit margins. This is bad news for the consumer. Inflation is up for what we need. Inflation is down for what we want. Now, this is unfortunate for us, but think in terms of the macroeconomic picture. We need what we need. That's, obviously housing, food, things of that nature. But the corporate profits for the things that we'd like to have, like apparel, think of all the stories of these chain stores that are being forced to close. Those corporate profits are really suffering. In terms of the Federal Reserve, they don't need to cut rates, not anytime soon. Our market strategy, we need to stick with what's working. Those hot stocks, take a look at stocks like Nvidia and Netflix, just had tremendous earnings. That's what's working now. And there's no reason to believe from a macroeconomic point of view, the situation has changed. A lot of these stocks are making new highs. Stocks are making new highs, have the probability to go even higher. And of course, it won't last forever, but the trend is your friend. And that is a trend right now. And don't expect those weak stocks, the laggers, to turn around. It's just not in the cards at the moment. Also, as a reminder, and we'll provide a link in the description of this video, join our free Substack newsletter. We talk about a lot of these macroeconomic ideas and much more. We hope this has been helpful. We look forward to seeing you back soon.